On May 11th, Intel did the unthinkable. They cracked TSMC's monopoly by securing a preliminary agreement to manufacture custom silicon for Apple. And on top of that, they locked in Elon Musk's staggering $119 billion terafab project to produce chips for Tesla and xAI. By all accounts, an absolutely flawless day of industrial execution. But then, within just 24 hours, Intel's stock violently plummeted almost 7%.
So you've got this staggering disconnect between record-breaking industrial demand and massive market sell-offs. And look, this isn't some spreadsheet error. We are literally watching the very first major collision between the unstoppable force of the AI infrastructure boom and the inescapable gravity of macroeconomic physics.
Well, we can trace this market retreat directly back to its source, and it's a fascinating chain reaction. It started with geopolitical friction in the Middle East, placing global oil supplies at risk, which pushed Brent crude past $107 a barrel. Now, that surge in energy costs didn't happen in a vacuum, right? It triggered an unexpected inflation spike, pushing the April CPI to 3.8%. And that hotter-than-expected inflation data ultimately sent the 10-year Treasury yield soaring to a one-year high of 4.46%.
Notice how that yield acts as an actual physical force on valuations. In the financial markets, higher bond yields act exactly like gravity on long-duration tech assets. When the cost of capital goes up, the present value of a high-growth company's future earnings systematically shrinks. This dynamic violently compressed the multiples of companies like Intel, completely overshadowing the fact that they just won some of the most lucrative manufacturing contracts of the entire decade.
And you can really see the lesson here when you look at how different investors reacted to the drop. As the tech sector bled out, retail investors attempted to bottom fish this sudden dip, treating it as a temporary discount. But watch what the institutional capital, the smart money, did instead. They aggressively redistributed their assets out of high-flying technology names and rotated directly into the old economy energy, materials, and industrial sectors. They're moving capital into the very resources that physically power and build this AI expansion. This behavior feeds right into a much broader market debate. Legendary investor Michael Burry has been warning that this whole AI momentum is a mirror image of the 2000 dot-com bubble, driven by pure momentum rather than underlying fundamentals. But look at the structural differences highlighted by Goldman Sachs. During the dot-com peak, market leaders carried a massive 52x forward price-to-earnings multiple with very low physical infrastructure spending. Today's tech leaders trade at roughly 20 times forward earnings, and they are backed by a staggering $750 billion in capital expenditure from hyperscalers, the tech giants actually building the cloud. That $750 billion in capital expenditure brings us right to a fascinating physical limit. We often think of AI as infinite software, but the data centers themselves are bound by hard physical constraints. As models become vastly more complex, the real bottleneck is no longer just raw GPU processing power. The actual friction point is the memory crunch, the speed and volume of physical memory transfer moving all that data back and forth. This makes companies like Micron Technology absolutely foundational. Micron's high-bandwidth memory chips serve as the vital physical roads linking these AI processors together. The demand is so ravenous that hyperscalers are paying massive premiums to secure supply, leading Micron to fully pre-sell their entire production capacity through the end of 2026. As a result, they've achieved a truly staggering, record-breaking 74.8% gross margin. I mean, that number is just wild for physical hardware. Yet, despite executing perfectly, achieving those record margins, and securing binding contracts for literally every chip they can physically produce, Micron stock still dropped 3.61% during this market retreat. Why? Because investors are deeply wary of cyclical trauma. The fear is that these incredibly elevated margins will eventually attract massive, industry-wide capacity expansion, creating a future supply glut that crushes pricing power down the road. Perfect execution, it seems, just isn't enough to calm the anxiety of the market.
Now, taking a step back, adding immense pressure to these physical supply chain anxieties is a new, completely unprecedented variable. We are seeing global regulatory uncertainty actively reshaping the cost of capital for the entire hardware sector. Market participants are no longer just modeling out supply and demand, they are aggressively pricing in geopolitical tax risk.
Here's exactly what that looks like in practice. South Korea recently floated a massive AI dividend proposal. The idea being to tax the extraordinary gains of the semiconductor era to fund a citizen dividend. We are talking about a single proposal potentially saddling hardware giants like Samsung with a corporate tax bill exceeding $72 billion in a single year.
Framing this strictly as an economic headwind and a shock to the cost of capital, the market's reaction was brutal and instantaneous. This single regulatory proposal instantly wiped out $300 billion in market value from South Korea's Kospi index in a matter of hours. It proves just how hypersensitive the AI trade has become to political redistribution risks. When a single policy suggestion can erase hundreds of billions in value, the calculus for investing in physical tech infrastructure fundamentally changes.
So the crucial takeaway here is this: the convergence of stubborn inflation, physical data center bottlenecks, and sudden global tax proposals confirms a massive psychological shift. We've moved from a phase of pure optimism, where AI stocks went up purely on potential, into a period of disciplined validation. Every $1 billion spent on AI must now prove its worth. Moving forward, the data points us toward two very different, highly probabilistic scenarios for the future of this sector.
The first scenario is what we'd call the structural break. In this reality, hyperscaler demand is so critical to the future economy that tech giants will continue paying premiums for chips, regardless of underlying macro conditions, permanently smoothing out the historical boom and bust cycle of the sector. The second scenario is the mean reversion. Here, the $200 billion in planned industry-wide capacity expansion eventually outpaces actual end-user AI adoption, creating a devastating supply glut that crashes pricing across the board. Now, as an analyst, you have to look at what data would actually invalidate these scenarios. The structural break bull case? That could be completely invalidated by the very foundation of the real economy, the consumer. Currently, U.S. consumer sentiment is sitting at a historic 74-year low of 48.2, battered by those high energy and inflation costs. If this forces a real contraction in everyday spending, it will ultimately starve these multi-billion-dollar data centers of the end-user software revenue they need to survive. On the flip side, the mean reversion bear case could be neutralized entirely on May 20th. This is when NVIDIA releases their highly anticipated earnings. If NVIDIA not only beats expectations, but demonstrates that the ramp-up of their new Vera Rubin platform is driving an undeniable, accelerating wave of fresh capital expenditure from those hyperscalers, well, the fear of an immediate supply glut vanishes. As the biggest technology companies on Earth pour hundreds of billions into physical infrastructure, we are witnessing a massive department store escalator effect, where companies must spend astronomical sums simply to keep up with their competitors and avoid falling behind in the AI arms race. So, looking at the data, the physical bottlenecks, and the shifting macro environment, we have to ask, is this escalator effect forcing these companies into a massive, capital-destroying race to the bottom? Or are we witnessing the unshakable foundation of a brand new trillion-dollar global economy?
An investment in knowledge pays the best interest, so why not invest in this channel? Click like and subscribe for more.